In this video, we're going to talk about building wealth with real estate and why a conventional loan and getting a multifamily property is the key to doing it and how to do this. My name is David Xie with the Xie Mortgage Team, and we're going to talk about the type of loans that you can get that are conventional. So there's Fannie Mae and there's Freddie Mac and how to use them for multifamily properties. So one of the biggest misconceptions out there is that on all conventional loans, you're going to have 20% down. It's totally not true. Also, there's a misconception that you could possibly get away with lower down payments or even have too much down payment to purchase that multifamily property, which is also not true. Let's go ahead and talk about the guidelines and how to get qualified for a conventional loan to purchase a multifamily property. Let's talk about the down payment first, because money is always important, right? We'll talk about down payment, which is your assets, and then we're going to talk about the cash reserves that are needed, and then we'll get into how to qualify for these loans. Down payment, we'll just call it loan to value, okay? How much loan you're going to get versus the value of the home. When you're getting a standard conventional loan, whether it is with Fannie Mae or Freddie Mac, a 2-unit is going to require 15% down. When you go with a 3 to 4 unit, the down payment requirement differentiates from conventional Fannie Mae, which is 25% down or 75% loan to value, or going with a Freddie Mac, which is 20% down or 80% loan to value. And this is for primary residences only. If you're getting a multifamily residence, then the loan to value for an investment property is going to be 75% loan to value, which is 25% down. Same thing across the board for a Freddie Mac or Fannie Mae. Where it differentiates is the affordable conventional housing, okay? And you really need to pay attention to this because this is probably the most important. When you're doing this, you're getting a Fannie Mae loan. The down payment requirement for a 2-unit is 15% down and 3 to 4 unit is still 25% down, okay? The maximum loan to value for a affordable housing, which is Home Possible through Freddie Mac, is going to be as follows. So with Freddie Mac, their affordable housing is called Home Possible, okay? And with that, it's excellent. When you're buying a 2-unit property, it's 95% loan to value. The only differentiating factor is if you get a super conforming, that's something a little higher than your standard conforming loan rates. However, not to the point where it's a jumbo loan yet. And that's going to be 15% down, 85% loan to value. A 3 to 4 unit is going to be capped at 95% loan to value. So 5% down is all you will need on a 2-unit, 3-unit, or a 4-unit, as long as it's not a super conforming loan. 5% down can be done on a conventional loan. And then finally, if you're getting an adjustable rate mortgage, it is 75% loan to value, so 25% will be required. If we have to go manual underwriting, all the guidelines are kind of thrown out the door a little bit, and we look at a lot of different factors: how many units, what your debt to income ratio is, whether it's higher or lower, and then the different types of affordable housing or standard conventional loans if they're being used. So now that we've addressed all the loan to value restrictions on this and the down payment restrictions, we're going to talk about how are you going to purchase this, okay? And is your income going to be good enough for all of this? So do we need a non-occupant co-borrower, and is it permitted to purchase a home with any of these products? So for Fannie Mae, a non-occupant co-borrower is totally permitted across the board, okay? Whether you're getting a standard conventional loan for a multifamily or a home-ready property and even a manually underwritten loan. However, there is a restriction on your debt to income ratio and how much that can be. So if you have one source of income, or maybe you and your spouse has a source of income, you may need that third person to kind of add that additional income to push you over to be able to qualify. Then a non-occupant co-borrower would be really beneficial to you, right? That's someone that's actually not living in the house. We're using their income and credit and debts to kind of qualify, and maybe having that additional source and backup is going to help you out. Now, the Freddie Mac, this is where it gets a little tricky and different, okay? Freddie Mac, on their traditional investment or multifamily primary purchases, will allow a non-occupant co-borrower. However, if you're getting the affordable housing, that is not going to be allowed. They will not allow a non-occupant co-borrower on a Home Possible 5% down multifamily purchase. The reserve requirements are going to differentiate now from both of the different types of properties. However, if we're looking at manual underwriting, that's going to be specific. However, if we're looking at regular AUS approval, which is automated underwriting system approval through desktop underwriting for Fannie Mae or Loan Prospector through Freddie Mac, when we get those findings, they're going to tell us how many months of reserves are needed. However, if we go with the manual underwrite, that means we can't get an approval through the automated underwriting system, and we actually need an underwriter to look over it. Then on a 2 to 4 unit, you're going to need 6 months of reserves for the principal, interest, taxes, and insurance, and any association fees. Not only will you have to have the money for down payment, you'll have to have it for at least whatever you have to cover for closing cost if the seller's paying for part of it. But on top of all of that, you're going to need 6 months of principal, interest, taxes, and insurance reserve requirements in the bank prior to closing on the property. So it's a little more challenging. If you have multiple properties that you're financing, then you are going to have cash reserves for them additional properties. So let's just say you're looking to buy a 4-unit now, and you have 3 other properties, right? So if you have 3 other properties, then these are the reserves that I'm talking about. So you'll have to not only have the reserves for your house that you're purchasing with this loan, but you'll have to have cash reserves for each additional property that you have financed through any other type of loan, whether it be a conventional loan, VA or FHA or USDA loan. Where it gets a little different is accessory dwelling units. Accessory dwelling units are sometimes permitted and not permitted, but let's just really break this down a little more before you go down this rabbit hole of purchasing a single family home with a mother-in-law suite or accessory dwelling unit. If you're doing that type of purchase, then that should be considered a single family purchase with an accessory dwelling unit. Those can be used with just your standard conforming guidelines. However, if you're purchasing a triplex, a quadplex, or a duplex, and you're wanting to purchase one with an accessory dwelling unit, on Fannie Mae, if you're purchasing a 2 to 4 unit, accessory dwelling units are not permitted, okay? So we will not be able to finance those loans with Fannie Mae. However, with Freddie Mac, it can be financed. On a 2 to 3 unit, 1 accessory dwelling unit is permitted per property. However, anytime you go to a 4 unit, a quadplex plus an accessory dwelling unit will not qualify. So at that point, you're going to have to seek out maybe a conventional loan. And then finally, landlord experience may or may not be needed. And, if you have landlord experience, it's definitely going to be a compensating factor that the underwriters as well as the automated underwriting system is going to allow. However, for the affordable housing through Freddie Mac, if you're getting Home Possible and the Community Land Trust, then you're going to have landlord experience through a class that you have to take to qualify prior to it. So what are some of the benefits? The benefits of owning a multifamily unit is definitely highly beneficial. We're in a time that, if you're able to generate income or make your housing more affordable, it's definitely a plus. And that's why a lot of people are really jumping in on the multifamily purchases, because you're able to live in one unit and rent out the other units to kind of help you cover it. So let's just give you an example. Let's just say you have a $4,000 a month mortgage payment. You're getting a very expensive fourplex. With that fourplex, you're able to collect $1,500 a month, okay, for your rent on each one of the units you're not living in. So stay with me on this. We have a $4,000 a month mortgage payment that you're going to be obligated for. And then you have 3 other units that you can rent out for $1,500. $4,000 a month for mortgage and $4,500 a month for your monthly rental income. So you're actually going to be making $500 on this every single month. So anything that you put on top of that as a principal reduction will certainly help you pay everything down. The other benefit is that you can claim this on your taxes, okay? If there's a loss, you're going to claim it on your taxes. If it's a gain, please have some cash reserves set aside before tax time so you're not owing the IRS after tax time. Always, have a contingency reserve for any maintenance that needs to be done, because you're not just maintaining your own unit that you're living in. You may have to maintain one of the other 3 units that you're living in. So having a maintenance contingency is really important. But ultimately, this is all about building wealth, right? This is all about utilizing this program to its fullest potential, getting a discount on your mortgage, being able to have other units help you pay the principal down. And this is a great way of really just dipping your toe into this to see if this is something that you want to work with, see if you want to become a landlord in the near future. So if you have any questions or concerns, or are concerned because your lender is, got a bunch of overlays or anything like that, please give me a call. I know this like the back of my hand. I'd love to help you out. My phone number is 757-478-8493, and this is David Xie, and I'm out.